Unit 3. Basics of Bookkeeping, Bookkeeping Rules. Bookkeeping is the most important part of accounting. It is orientated in the past, and only records business events. Bookkeeping is the recording on a day-to-day basis of the financial transactions that include purchases, sales, receipts and payments incurred during the business activity of a company or an individual. Business transactions will be recorded based on supporting documents that describe and explain this transaction. These supporting documents should contain all necessary information that is required for bookkeeper to work successfully and monitor business changes. After reading this unit, you will be able to understand the basics of bookkeeping and bookkeeping rules. Realize the differences between accountancy and bookkeeping. Learn what is a chart of accounts. Introduction. Bookkeeping is a part of accounting in which business transactions are recorded in accounting books using the double entry system. The double entry system based on assumption that every transaction has two parts and on the one hand is increasing one account and on the other hand is decreasing another account. Accounting versus bookkeeping. Bookkeeping is the daily recording of business transactions into the accounting system, that is the identifying, measuring, recording and classifying of routine business transactions, while the accountant must have a wider range of knowledge and skills. Bookkeeping includes recording of business transactions, posting debits and credits, producing of invoices, reconciling accounts balances and ledgers, preparation of payrolls. Accounting is a next-level process that uses information prepared by a bookkeeper for production of financial statements. Accountants must understand many regulations, in particular, income tax rules, value-added tax, accounting standards, and be able to present all types of accounting information to managers, present financial statements and offer alternative solutions that would improve and optimize business operations. The entire purpose of accounting is to provide useful information to end users. Accountants should present that information in a way that makes sense to investors, creditors, and anyone else who is looking to make decisions about the company. The accounting process culminates in the creation of the general-purpose financial statements. To qualify for the title of an accountant, an individual should obtain a bachelor degree in accounting or finance. Accountants with sufficient experience and educations can obtain the title of Chartered Certified Accountant from Association of Chartered Certified Accountant. To become a member of ACA, an accountant must pass ACA exams, possess relevant professional experience and continue its professional development ever since. Accounting involves review of work of bookkeeper and posting adjusting entries if needed, preparation of financial statements, analysis of financial results, cost analyze, preparation of tax returns, communication with the owner and help in understanding the end results of different business decisions. Accounting can be defined as the most important source of information about the company, that is a comprehensive system of records in which plans, records, controls and analyses of the assets and operations of the company can be performed, and on that basis, compiles the accountancy and financial statements. As a result of accounting, financial statements will be issued that combine together key financial indicators of the company. It will give a better understanding of a company's profitability and will bring awareness of the cash flow in the business. In other words, we can say that accounting turns the information presented in the ledger prepared by a bookkeeper into financial statements that show the bigger picture of the business and company trends. Business owners will often rely on accountants to help with strategic tax planning, financial budgeting for the next periods, compliance with tax filing and tax payments. Chart of accounts. The chart of accounts appeared in accounting history for the first time at the end of the 19th century, while its more significant application began in the 50s of the last century. A chart of accounts is a created list of accounts used by the company in its accounting system for recording assets, liabilities, sales, costs, expenses, etc. It is usually organized in such a way that assets, liabilities, sales, costs, etc. are segregated in order to give an interested party an easy understanding of the company's financial structure. In some countries, a general chart of accounts is defined for accountants. It has a general layout and may be even regulated by law. In other countries there may be only general guidance and it is left to accountants to design their own chart of accounts, like in Cyprus. The chart of accounts is a list with all the accounts of the company. Every account should have a unique code that can be numerical, alphabetic or both. IV. Account schedule in the chart of accounts. Every chart of accounts should include the following type of accounts. Asset accounts, they will represent resources owned or controlled by the company. Some examples of asset accounts can be cash in hand account, bank account, inventory account, financial investment account, debtor account, account receivable, etc. Liability accounts, they will represent the economic obligations of the company. Some examples of liability accounts are creditor accounts, accounts payable, bank loans accounts, accrued expense accounts, tax liability account, etc. Capital, equity, accounts, they represent the capital of a company and include share capital account, share premium account, retained earnings account, etc. Revenue accounts, they represent the company's income and include sales of goods account, rendering of services account, interest income account, dividends income account, etc. Purchases accounts, they represent purchases done by the company for the production of goods or services and include purchases of material account, transportation account, etc. Expenses accounts, they represent expenses that company incurred while running the business and include bank charges account, rent account, depreciation account, salary accounts, etc. The basic example of chart of accounts can be as in the following table. The accounting principles. In order for the financial statements to serve their purpose, or to give a true and fair view of the company's state of affairs, the accounting principles and assumptions are used and serve as a starting point for the development of accounting standards and policies. Based on IAS 1 presentation of financial statements, the general principles of financial reporting are: going concern, accrual basis of accounting, materiality and aggregation, offsetting, frequency of reporting, comparative information, consistency of presentation, matching principle. Going concern. Going concern means that a business will continue its operation in the future for at least the next 12 months. The owner of the business has no intention to liquidate the company or significantly reduce its business activity. Accrual basis of accounting. The concept of accrual accounting states that income and expenses should be recognized when occurred regardless of when received or paid. This means that the recognition of a business event does not depend on cash payments or receipts, but from the fact of occurrence. Materiality and aggregation. Based on this principle, it is necessary to distinguish which position or information is significant or material, and whether it should be presented separately in the reports, or displayed grouped with other positions. The measure of the item is significant if its disclosure could affect the user making a business decision based on financial statements. Offsetting. This principle states that a company should not offset assets and liabilities or income and expenses, unless required or permitted by IFRS. Frequency of reporting. A company shall prepare a complete set of financial statements at least annually for the purposes of interested users. Comparative information. The user of the financial report should be able to compare the current report with the reports from the previous periods, as well as with reports of other similar companies. Consistency of presentation. This principle requires the accounting policies to use recognizable and measurable positions in the financial statements, which are then applied during multiple accounting periods. Otherwise, accounting policies could become instrumental in manipulating the financial statements. Matching principle. This principle aims to set in line revenue and expenses. Expenses should be recognized in the period the revenue from them were earned. In addition, revenue should be recorded in the period the expenses incurred to receive that revenue were recognized. This principle is a result of the accrual concept. VI. Accounting based on legal and professional standards. Accounting standards are issued by the International Standards Board, IASB, and are adopted by Cyprus. Therefore, all Cyprus companies while preparing their financial statements should follow accounting standards issued by IASB. When the IASB replaced the International Accounting Standard Committee, IASC, in 2001, it adopted previously issued accounting standards, IASs. At the same time, it started to issue other standards as International Financial Reporting Standards, IFRSs. IFRS cover different aspects of accounting from IAS, so they do not duplicate each other. International Financial Reporting Standards and International Accounting Standards include: accounting standards are the main guidelines for accountants on how to account different business transactions, how to present them in the financial statements, and what transactions to disclose for internal and external users. All companies in Cyprus, irrespective to their size and activities, have to prepare and submit to audited financial statements to the Registrar of Companies and to the tax authorities. This means that big, small, dormant companies will all need to prepare audited financial statements and submit them to the relevant authorities. First financial statements can cover up to 18 months from the date of the company's incorporation. If a company is incorporated before 30th of June of a current year, then its first period for preparation of financial statements will be from the date of incorporation until 31st of December of this current year. For a company incorporated after 1st of July of the current year, the first period for preparation of financial statements will be the period from the date of incorporation will 31st of December of the next year. Even if the company had no operations for a particular year, was whole year dormant, it is obliged to prepare and submit relevant financial statements. The accounting system in Cyprus is based on IFRSs and IASs. Since Cyprus introduced international standards and did not adopt them by issuing local accounting standards, made it easier for external users to read the financial statement of Cyprus companies. That is why European banks accept audited financial statements of Cyprus companies and rely on them, since they know that Cyprus accountants and auditors follow internationally accepted accounting and audit standards. Also, European banks accept and rely on financial statements prepared by Cyprus accountants and audited by Cyprus auditors for UBO offshore companies that do not require accounting or audit under local legislation in their countries.